So yeah, my question is for the setup, like understanding capital gains tax. Why is that important to note with this granny flat situation?
Because the granny flat becomes an investment and you're generating income out of that, and therefore that portion of that granny flat, the living area, is then added to, as an example, if you've got a granny flat that's 1/5 the size of your main residence, then the capital gains when you go to sell the property in the future, you'll be paying 1/5 of that capital gain will be a taxable event. So to give you a calculation,
great, please do.
It's capital gain multiplied by the years that granny flat's been rented, divided by the years the property's been owned, by the whole property, multiplied by like the area not considered for the principal place of residence. So as a calculation, say this property's gone up $500,000 in value
in 10 years. The main property.
Yeah,
the primary property's gone up in $500,000 in 10 years.
Yep, and you've
so it went from $500K to $1 million.
Yep, you've rented that, so you've got $500K in capital gain.
Yep,
but it's your principal place of residence. So a lot of people are thinking, okay, cool. Well, I don't have to pay tax. I got $500,000. You know, I can sell this property for $1 million. I can now use.
Okay.
I've got debt on this now at $200,000, so I've got $800,000 in cash to go and buy another property.
Yeah, but technically, from that $500K, 50% of that is a capital gain. It's $250, and then you're going to get a 50% discount on that, which is $125. Is that right?
No. Well, the mindset of the principal place of residence people are, well, I don't pay capital gains tax. But if you're adding
because what the other example was that's an investment.
Yeah, this is
got you.
Yes.
Yeah.
Good clarification.
Yep.
So if you add that granny flat on and you're renting that out, that portion is actually triggers a capital gains tax event in the eyes of the government, apparently. So to give you a better calculation is, it's gone up $500,000 over, like you've owned it for 10 years. Of 5 of those years, say you've been renting out that granny flat, so the calculation is $500,000 multiplied by the years that you've rented it and divide that by the years that you've owned it. And then if you're, like say in this instance, that the area of that granny flat is 1/5 of the total living area of all, like the main residence.
Residence, yeah.
Then you multiply it by that 1/5. So in that example, you'd be looking at about $50,000 in capital gains tax. But because you've held it for over those 12 months, you also get that 50% discount. But that's still $25,000 in my eyes, which people aren't really understanding how this calculation can work. So that's why I always push people to talk to their accountants to understand this further before going. And, you know, like you got to understand what you're doing as a full picture before you do it. Otherwise, you'll get caught with your pants down, because you might go and sell your property, buy another principal place residence, you know, and fully leverage yourself out. And then, you know, after tax time comes, the government come out and go, oh, you owe us $25,000. And you're like, what for? So, yeah. And also, if you're generating income out of the granny flat during that period, you know, it's triggered against your income for that year as well. So it's going to increase your tax bracket potentially.
Increase your taxable income, which may actually put you into a larger percentage.
Or like you're going to pay tax on it anyway. So if you're in that bracket of 30%, then you know your $300 a week is, you know, you've got to pay, what's that, $90 essentially on a 30% rate.